We are a pre-seed and seed stage investment fund headquartered here in New York City. We've got about $1 billion under management today. But really our focus is we write the first sort of $500,000 to $3 million checks, generally leading pre-seed and seed rounds into companies. Our focus has been on backing very technical teams over the years. We do a lot at the intersection of AI and enterprise software. We do a lot at developer and infrastructure. And finally, what we call native AI, which I can talk a little bit about later. Our more notable investments here in New York, where we were in the seed rounds, are companies like Better Cloud, NS1, MongoDB, amongst others. And I guess one of the notes I'll say, just because it'll probably weave into this, will be I actually moved to New York about 16 years ago. And relatively early on in my journey, I had this very fortunate moment to reach, through Craigslist, nothing nefarious, the two founders of WeWork when they opened the very first floor at Grand and Lafayette. And I wound up collaborating and creating what we called WeWork Labs with Adam and Miguel, and spent the next 6 years building that company from 4 to almost 4,000 employees, scaled that up. And so got into the venture world because I was surrounded by, well, tens of thousands of entrepreneurs in New York, and then hundreds of thousands around the globe within our buildings. And I would travel around and meet all these entrepreneurs, and I wound up investing them as an angel investor and eventually as a VC.
How should founders think about the role of the lead investor, and what should they optimize for?
All right, I'll maybe answer this in two ways. So cut me off if I'm running too long. I'm very long-winded. This is what our PR people had told me before. So I would say, I'll be blunt, you should optimize if you're raising your pre-seed round, which most people are. You should optimize for speed of close. Like lead, co-lead, not a lead, party round, whatever kind of round you raise, and I could talk about the specifics. I think in this day and age, things are moving so quickly that often I would encourage you, if you're raising your first $500,000, $1 million, is to get a product out the door, to prove some thesis. Timing matters. I don't know if any of you follow the OpenAI news. You probably do. Every single week, OpenAI is launching something that's eating some massive part of the technology world, Anthropic, Meta, you name it. And then there are thousands of startup founders doing the same. And so my blunt answer to that when I talk to founders when they come into our office is optimize for believers moving quickly and backing you. Don't wait for some crazy magical thing to happen, some mystical lead who's going to be the one person that gets you, offers you all the money at the best terms, at the highest price, with no strings attached, whatever. Sometimes it does happen, but frankly, like, time is your enemy in most startups.
So as a primarily seed stage investor, right? When you look at a startup that has raised a pre-seed round, how much do you care about who led it, who invested, all those things?
Yeah. So signal matters a lot in venture. I mentioned this earlier, but a lot of it, not a lot. We all have FOMO. Most people have FOMO. My kids have FOMO. But as investors, we also do. And so I think signal does matter a lot. But I would say signal along with conviction is what we're looking for. So you may have raised a small round of capital. You may have raised what they call a party round. So no one's sort of the biggest check. Maybe everybody wrote $150,000 checks. You added those all up to get to $1 million. So no one really stepped up and wrote the biggest check in the round. If there's somebody who understands your market and they know you well, and they show they have this high conviction, they're leaning in, they're doubling down on that check, like, that's actually what matters more than sort of the brand associated with the pre-seed fund, I would say.
Okay, so can you walk us through what it looks like, a typical deal for you leading a seed round, from the time that you met the founder through the whole process, and kind of sharing the things that like founders can learn from that process?
Yeah, so I'll share two seed deals that I've recently done, and you will hear they are vastly different. So this is maybe a cop out of an answer, because there is no one size fits all. So I don't care how many headlines you read in TechCrunch or anywhere else. Like, it's just not how it comes together. Don't believe any of those headlines, as I said before. So one deal recently is maybe the longest I've ever gone from commitment to closing, which was roughly 18 months. This is not normal, but it may be a journey that you go on, and so I'm going to share it. This is a founder who sold his last company. It was a pre-seed round, so like he didn't have to prove anything, to be clear. This is a founder who sold his previous company to Snowflake and went there for about 4 years as an executive there, and wound up working on a bunch of really fascinating initiatives between their native apps and their AI stuff. And about 18 months ago, maybe 20 months ago now, he came to me and he was like, I have this idea for a company. It's at the intersection of AI and native apps and databases, and specifically in Snowflake. And I was like, I love it. I want to back you. He's like, okay, what would a deal look like? And I said, great. I want to buy somewhere between 15 and 20% to invest and lead your pre-seed round. And you tell me sort of how much capital do you need. You kind of know my range. You can go on the signal. You can see how much I normally invest, or I'll tell you. And so tell me how much capital you need, and we're going to back into a number. Like our math at the pre-seed and seed, and most investors, it's entirely driven by the amount of capital you want to raise and the percentage ownership that I target as an investor. That's how we get to a post-money price. And so it's not done through like comps or any of that, which happens later on. So we went back and forth, and we had this whole deck. He like made a deck for me, like just for me, that outlined how I was going to own this amount, what he's going to accomplish, all this stuff. Fast forward 12 months, he had not left his job. He was still at Snowflake doing amazing things. And so I hadn't invested. We hadn't closed. I said, when the day you leave, I don't want this to be a conflict. The day you leave, happy to wire the money. Like, let's do it. And he stayed there, and he wound up learning more, and he wound up connecting with more of the executives, and he wound up moving on this idea, but at his own pace. And about, now call it 8 months ago, came to me and he's like, all right, I think I'm ready to go. He's like, I'm going to do it. And then he called me about a week later and he said, my wife's pregnant. I think I'm going to stay at Snowflake. And I said, that's great, man. Like, let me know. I still want to back you. And so now 8 months later, 9 months later, he finally left, and we closed like a month ago. And the round wound up being 1.275 million. I'm trying to make sure I have the number exactly right, for roughly 15% of the company.
Any other general advice you have to folks in the room on securing a lead investor and how to think about it?
Yeah, I made this comment before, and I just want to double click on it, which was, it's your job to tell me what to get excited about. One of the biggest failures I see in founder pitches at pre-seed or seed is that I walk away from the pitch both either not being excited, so you just haven't created a story of excitement. Like, storytelling is a huge part of it at pre-seed and seed. It's like, you want to connect with me at a human level, and you want me to leave being like, shit, that sounds awesome. Like, I can't imagine the world not looking like that. I can't imagine you not succeeding as a founder, right? We call it the Pied Piper effect, not like Silicon Valley, the TV show. This is like the kid's fable, the little guy playing the flute. Convince me to follow you like crazy early, like way before I should rationally follow you. So one is storytelling. But the other one I'd say is, the second problem is I leave not knowing what is exciting about your business. Not the market, not the approach, not the product, but like, why should I think that you're on the right path? And so help me to anchor on very bluntly, like, what KPI should I care about? If you're just getting started and you've got 10 users, that's it. You're a consumer company of 10 users. I'm probably not excited about your user count. If you're an enterprise company and you have $1,000 in revenue, I'm probably not excited about your revenue. So give me a reason to be excited. Give me something to anchor on. Oh yeah, I'm only making $1,000, but that one customer, it's only one. They're spending 20 hours a week inside of my app, like using it hundreds of times. I have an early stage startup called Talktastic, and they have less than 1,000 users. They're a prosumer app. They have zero revenue. They have less than 1,000 users. They haven't launched their paid product yet. Their users are spending upwards of 3 hours a day using their product.
Wow.
Like, I mean, and it's a pretty buggy product today. Like, I'm one of those avid users, but like, that's an exciting thing to anchor on. So don't leave me thinking to myself, wow, you've been live for a few months and you have less than 1,000 users? Like, that doesn't sound very good. Like, I could probably get 1,000 users from my email newsletter, I think. I'm not sure. So those are two things I'd say. Tell a strong story, leave me excited, but also tell me what to remember at the end. And I will give you one word of advice if no one's ever done it. Take an improv class. It is the best thing you could do as an early stage founder. I've done it many times in my life. Yes, and is so important in the room, because if you want me to leave excited, I certainly shouldn't feel like we got combative about anything. And that happens more than you would know. But more importantly, like, you got to build on what's exciting me. Like, it may not be the pitch you delivered yesterday. The thing that hooks me may be something that you nail in that meeting, and you want to continue that with me.
I think that wraps it up for us. Thank you so much, Jesse.
Oh, thank you for having me.